If you have ever dreamt of working in the tech industry, you have probably dreamt of working in Silicon Valley, the world's renowned technology and innovation hub, and it is now worth almost $3 trillion thanks to tech giants like Apple, Google, Tesla, and so many more. And for scale, there are at least 585,000 tech companies alone in the US, over 6,600 of which are in Silicon Valley alone. Who would have ever thought that this piece of land would have such a profound impact on you and I? And let's be real, we all eat, sleep and breathe technology these days. Whether it's your smartphone's apps or your laptop, Silicon Valley's influence is undeniable. And this, my friends, means money. If you're looking to be more than just a consumer but possibly an owner of all of these tech companies, look no further, as I'll be diving into one of the 11 stock market sectors and a crowd favorite, the technology sector. Basically, tech is the area of the stock market devoted to all things technological innovation, growth, and development. It is also a highly concentrated sector. I kid you not, the tech sector by itself holds over 26% weightage in the S&P 500 index today. And if you add in 4 other tech-related companies that are in other sectors, Google, Amazon, Meta, which is Facebook, and Netflix, that weightage will shoot up to over 38%. And once you start investing, I wouldn't be surprised if you have a tech-heavy portfolio. Now, back to what the tech sector is all about. It can be further broken down into 4 main subcategories. First up, software and services. This category includes companies that develop software for the internet, computer applications, database management, or home entertainment. It can also include data processing, technology consulting, and outsourced services. And without software, nothing much happens in the modern world today. Really, as companies of all sizes and types rely on software solutions for different functions. Take Gmail for example, or Google Docs, Microsoft Excel, Adobe Photoshop, you name it. Those are some of the softwares that literally powers an entire company or even nation to move forward. Next, hardware and equipment, which includes manufacturers and distributors of your computers and electronics. Yeah, the device you are using to watch this video on YouTube right now. The hardware industry can be further broken down into many subsectors, including communications equipment, computers and peripherals, networking equipment, technical instruments, and consumer electronics. You can think of companies like Apple, Micron Technology, and Dell. And thirdly, networking and the ever-amazing internet. Don't be fooled by the name, as it is arguably the biggest tech innovation since the invention of microchips. The creation of networks has not only improved the quality of life for most of us, but enabled major changes to commerce with new business models such as mobile banking and software as a service (SaaS). Some of the biggest players in this subsector include household names like Cisco and AT&T. And lastly, semiconductors. They are an essential component of electronic devices that we all use today, such as televisions, computers, medical equipment, mobile phones, and gaming consoles. And it's a huge market on its own, both the US and the world economies. Currently, the $300 billion semiconductor industry is made up of electronics companies and manufacturers located in the US, Japan, China, South Korea, France, and Italy. And there are names like Intel, AMD, and Nvidia. Now, do you know that we used to have this saying whenever people talk about the US tech sector? By default, they will be referring to the FANG stocks, FAANG, Facebook, Amazon, Apple, Netflix, and Google. But nowadays, the tables have turned and companies like Facebook and Netflix have fallen off the rank as they got disrupted by many factors. See, even the greatest US tech companies are not immune to its competitors. Anyways, let me show you some of the quantitative metrics that I would use to compare these tech stocks using these 5 household names that you probably have heard before. Firstly, forward PE ratio is basically their current share price divided by their estimated earnings per share (EPS) for the next 12 months. The idea is the stock market is forward looking and it's better to evaluate them based on the projected numbers in the foreseeable future, as tech companies tend to be relatively volatile compared to other value stocks like Coca-Cola or McDonald's. But keep in mind that higher doesn't mean it's worse off. It simply just means investors are pinning a lot of hope onto their future earnings as their future trajectory seems more promising compared to its peers. And vice versa, Lower doesn't mean better, because sometimes it could also mean the company is probably plateauing in terms of growth. Next, PEG ratio or PEG ratio, or their current PE ratio divided by their EPS growth. Basically, a lower PEG means they are relatively undervalued compared to its peers. But obviously, as you can see here, all their PEG ratio is above 1 and some even up to more than 4 times, because they are all tech companies which usually stands at the front line of innovation, so it's only normal for them to fetch a much higher premium in the stock market. And lastly, enterprise value divided by EBITDA or EV/EBITDA is basically one of the most commonly used metrics to measure a company's value. It's something like PE ratio, but obviously it's different because they take enterprise value, which includes a company's total debt and cash reserves. Meanwhile, EBITDA is one of the P&L line that can tell you the operational efficiency of a company because it excludes their interest, tax, and non-cash expenses like depreciation and amortization. And in the venture capital world that I work in, this metric is easily one of the most important metric that any investor will look at. So just like PE ratio, a higher EV/EBITDA could mean they are relatively more overvalued. Now, investing in the tech sector can be pretty enticing, especially when everything we do today is literally powered by it. Not gonna lie, but I need to remind you, with all high reward investments, they all also come with high risk. Remember the dot-com bubble? In case you didn't know, it was a stock market bubble that was triggered in the US in the late 1990s by the rise and fall of technology stocks. The growth of the internet back then created a buzz among investors and venture capitalists who were quick to pour money into random startups, and heck, most of these companies were even able to raise money to go public even without a business plan, product, or track record of profits. The crash that followed saw the Nasdaq index free fall more than 75% from its peak at March 2000 within a span of 7 months, and by the end of 2001, most dot-com stocks went bust. Even the share prices of blue chip tech stocks today like Cisco, Intel, and Oracle lost more than 80% of their value during the dot-com bubble. It would then take 15 years for the Nasdaq to regain its peaks, which it did in April 2015. Now, my point here is, as Warren Buffett always say, never invest in a business you cannot understand, because every public company out there is going to sell you a dream, like it or not. So here are some things for you to keep in mind before you jump in. Tech companies are generally known to be secular growers. In other words, they are companies that would show significant and persistent growth over a long period of time and are usually not affected by short-term trends. But it's important to remember that just because a company is a tech stock, it doesn't mean that the company will generate outsized returns and deliver growth by default. And just like any other industry, the tech sector has its own set of business metrics to consider as defined by JP Morgan, and that includes 1. Cost. As tech companies continue to innovate and modernize their products and services, they spend a lot on their research and development, and if a company is able to produce its product at a much lower cost, it will then have a significant advantage over its competitors. And 2. Copyrights and patents. Copywriting or patenting a technology can add a lot of value to the stock because it gives the company exclusive rights that its competitors have no access to. And thirdly, revenue streams. Tech companies, particularly those that fall under the software as a service SaaS category, have fairly consistent and recurring revenue streams because their clients usually sign long-term contracts for their services. However, investors also look at whether it is cheap or easy for users to switch from the company's services to a different provider, particularly when a large contract is set to expire, and that is what we call the churn rate. And interestingly, do you know that the tech sector also has an above average number of companies that do not produce any profits or cash flows whatsoever, which is a huge red flag. So this might be why so many investors are attracted to the profitable large or mega cap tech stocks that can already show strong growth in their share price at the get-go, like Tesla and Apple. Basically, no money, no talk lah. And keep in mind that the tech industry is very diversified in itself, so different tech companies may perform differently. For example, the semiconductor industry is famous for being a cyclical industry due to the relatively short lifespan of semiconductor items, as technology becomes obsolete so quickly when new and faster applications are developed. And on the flip side, software has a steadier performance and is considered a secular and defensive investment. And this means that these stocks are generally unaffected by short-term economic trends. Take Windows for example, they have been here for as long as the internet existed, since the last 30 to 40 years, right? Now wrapping up, if you are looking to start investing in the US tech sector, there are two different ways to do it. Either you invest in individual tech stocks via an international broker like IBKR, or if you prefer a more diversified exposure towards tech, you can opt to invest via an exchange traded fund ETF. And for a blanket exposure to most tech companies in the US, you may consider checking out this Nasdaq 100 index video that I have made here. And while no one can guarantee that big tech stocks won't suffer volatility and dips as we see here, their growth would most likely outweigh any losses in the long term. So if you are looking to build a diversified portfolio, why not consider adding tech stocks in your asset mix? As usual, thank you for watching, and I'll see you in the next one.